Some of the most dangerous products in finance are those which look simple on the surface, but a peek behind the curtain reveals something much more sinister. Leveraged ETFs are precisely this type of product, and they're some of the most widely misunderstood investments that, when misused, can absolutely annihilate an ordinary investor's portfolio. The most striking example is that both the long versions of these products, which benefit from prices rising, and the short version, which benefits from prices falling, of exactly the same ETF, can both be down over the same time period at the same time. This is extremely counterintuitive, so today I'll be showing you exactly how they work, having designed products like this myself at an institutional level, and why they are normally a bad idea for you to use, starting with this guy, the leveraged shares 5 times long S&P 500. There are many different leverage products out there, and this one in particular can be bought via popular brokers such as Trading 212, Interactive Brokers, and loads more. Technically, this particular range aren't ETFs, they're referred to as ETPs, Exchange Traded Products, which is the catch-all term that includes ETFs, but it's really irrelevant here as it's more or less the same thing, a packaged way to buy some particular strategy in an easy-to-trade format. Leveraged products are designed to match a particular underlying, i.e. whatever the reference asset is. In this case, this is the S&P 500 index and provides the daily returns of this index with some multiplier. This one in particular takes the daily returns and multiplies them by 5. Strangely enough, here is where the trouble begins. This part about daily returns is really important, and it has implications that aren't obvious at first glance, which ultimately can lead to staggering losses in certain circumstances and slow grinding death in others. So, what's the problem? At its root, the mechanism that makes these leveraged instruments totally bonkers is as a result of having to solve a very basic issue, preventing the price from going below zero when the market goes against them. In the example that we're looking at, that would be if the S&P 500 went down by 20%. A 5 times leveraged version that aims to match the daily returns would clock in a minus 100% return on that day, wiping out the product entirely. But what happens if the S&P goes down by more than this, say 25%? Given fully funded exchange-traded products like these can't trade at negative values, as investor losses are by design capped at the purchase price, pricing below zero is something that simply can't be allowed to happen. If products like these, or a stock for example, was allowed to trade at a negative price, then the implication there is that you owe more money than you ever put into the system. In general, an index is unlikely to drop by 20% in a single day, but an individual stock certainly can do this, especially around sensitive financial releases like earnings announcements. This is probably why leveraged ETFs normally only allow 5 times leverage on indices and up to 3 times for single stocks. So although an index is unlikely to fall by 20% in one day, it certainly could over a few months, and this is the reason that these products track daily returns. As it turns out, this is the magic bullet to fix the problem. Tracking returns specifically allows for increases and decreases in the index over the product's lifetime without the leveraged instrument threatening to hit zero all the time, because each time the product loses value, any further decreases start from a lower base value. But this can have some truly weird effects as the index moves up and down. Let me show you this simple spreadsheet which shows how this functions at a basic level, and we'll build it up as we go through. At its most basic level, we need to start by looking at the returns profile of both the index, which is our underlying instrument for our ETP, and the ETP itself based off the returns that we see. So the S&P index here, just for simplicity, we're going to start at 100 because it makes it a bit easier to see what's going on. Although obviously this could really be any number. And we've got over here our S&P times 5 ETP. This is our leveraged product, which we're also going to start at 100. In this theoretical scenario, the S&P index is going to lose 6% every day for 4 days. So it's going to go from 100 to 94. The day after it loses another 6% to 88.36, and so on until it gets to 78.07. How this is replicated on the S&P 5 times side is we look at the return of minus 6%, we multiply this by 5, which gets us to minus 30% here, and then we apply that to the product's value. So from 100, we go down to 70. On the day after, we have another 6% loss, so we multiply that up by 5 to minus 30%, and we again apply that to the 70 here to get to 49. We do this on each day with 30% negative returns, and we get to 24.01. So across the 4 days, the S&P index itself has gone from 100 to 78 and has lost just under 22% return, whereas the S&P 5 times ETP has gone from 100 to just over 24, which is 76% loss. Now, the important point comes in here is that to go back from 78.07 to 100, imagine the S&P index has an amazing day and it recovers all of its losses. We don't just need to regain 21.9%, we actually need to regain 28.1 because we're now starting from a lower base. This 21.9% applies to 100. So to go from 78.07 back to 100, we need to apply a higher number. So if we suddenly got this gain of 28.1%, that would take the S&P index back to 100, and nothing has changed between the starting value and there's no losses. Mapping this over onto our ETP, we take our 28.1% gain, we multiply this by 5, and this turns into a staggering 140.41%, which sounds pretty good. But unfortunately, when you apply this to the 24.01 price of the product after the 4th day, this only gets you back to 57.7. This shows you a prime example of why the pricing of this is very strange. Even though the S&P index has not lost any money, because of the way that these ETPs work, this has nearly lost half of its value. This is clearly quite an extreme example, but even in situations with lower volatility, this effect slowly eats away at the value of the leveraged version. If we simulate 100 days where the S&P is up and down each day by 2%, not going anywhere on aggregate, you can see that the leveraged version manages to get down to a value of 68, losing 32% of its value despite the actual index not losing anything at all. Now that we have seen how the long version performs, what about the short version? As this is the version that benefits from prices falling rather than going up as with the long equivalent, intuition would say that surely this one must have outperformed instead. Well, no. The minus 5 times S&P short ETP does exactly the same thing as the 5 times long, except in reverse. For each daily movement, that key wording again, the product is designed to gain or lose the opposite of this percentage multiplied by 5. If the S&P lost 6% 4 days in a row, as in our original example, our short-levered version initially soars from 100 all the way up to 285.6, the outright returns actually increasing from one day to the next. Because all the losses from the S&P are turned to gains and multiplied by 5, these stack on each other to produce bigger and bigger returns every day. It's only when we get to the final day where the reference index returns to 100 through a 28% gain that we see the problem. On this last day, the short version gets annihilated to minus 115 and ceases to function. Again, this is an extreme case, so plotting the short product on the same chart as before, where we had 2% up and down days back to back for 100 days, shows that this one also underperforms. In fact, it's even worse than the long. If you think that this is just a theoretical conversation and can't happen in reality, the chart for the long 3 times Nvidia ETP through the COVID losses in 2022 dropped this product by 98%. From the highest closing price of $15.60 all the way down to 36 cents. The mechanism that drives these strange return profiles is the leverage involved in both the long and the short side, which means that the strategy under the surface is required to increase the leverage when it's making money and decrease it when it's losing. This ends up with these ETPs overwhelmingly buying high and selling low, with losses amplified after a winning streak due to the leverage increase and gains muted by not having enough invested after a losing streak. The short one is even worse than the long because it not only buys high and sells low, but it takes the wrong side of the natural relationship between multiplying and dividing, which makes the return profile biased towards losing money. As you're very likely aware, if you multiply by a return percentage, say 10%, you can't just divide by that percentage to get back to the original value, as you'll end up with less than you started with. This gets worse as the numbers get bigger, so if you lost 50% on one day, you'd need a 100% return to get back to where you were. But because the short version is flipping this relationship, gaining 50% and then losing 100% afterwards, this would take the short to 0, even without any leverage. Unfortunately, this mechanism is actually necessary for the pricing of leveraged ETPs to make sense. Take for example our wipeout scenario on the short 5 times version that we looked at earlier. If we, as we did before, start the index and the ETP both at 100 for simplicity, the implication here is that under the bonnet, the 5 times short strategy has the effective exposure to the market of minus 500. As the index moves 6% lower from 100 to 94, our product returns 5 times that, and the minus 500 that we have invested moves plus 6% to 530. This gain of 30 is what takes the product from 100 to 130 and gives us our return of 5 times what the S&P did. But the issue now is that our exposure of 530 in the actual market doesn't match the 130 price of the ETP for the following day. If we did nothing at this point, we wouldn't actually achieve the 5 times daily return of the S&P index based on the new price of 130 of the product. Unlike investing in an ETF on an index with 1x exposure, where you can just hold on because the actual basket of shares that you have exposure to doesn't change from one day to the next, any product with a multiplier has to be rebalanced daily, otherwise the returns get out of line with the pricing and the whole thing ends up being a mess. Believe me, I've been in that situation myself trying to design these things. In our example, because the product is now at 130, to match the daily return properly, we need this times 5 invested as a short, which is minus 650. So at the end of the day, the short ETP needs to increase the actual market position from minus 530 to minus 650 instead, selling an additional 120 to bridge the gap. This moves the leverage to nearly 7 times, and each subsequent day that the index goes down and the 5 times leverage strategy earns more money, this means that it has to sell more and more and more to 9.5, 13, and finally just over 18 times leverage. This is why on the final day with a big gain, this ends up completely wiping out the strategy in its entirety. At this point, it's fairly obvious that these products hate volatility, and especially when prices are trending sideways. Up and down price movements around some average value causes any version of these to lose value over time, long or short, but markets don't always work this way and often trend upwards over time. This is why some of them can do pretty well, at least over the short term. A quick glance at the full list from the Leverage Shares website shows the ones that have performed the best over the last year. 3 times Alibaba? Sure, the stock has gone up about 82% in that time, and our ETP has seen around 219% returns. This drop in the middle certainly caused some issues, with the leveraged ETP dropping to all-time lows, which actually didn't happen on the stock itself for reasons that you probably now understand, but as it continued its upward trend after this, it has recovered to a decent level. This product has been around for about 7 years though, so I wonder how it's done over its As you can probably tell, I don't like these leveraged instruments very much, and I certainly don't recommend using them unless you're running some pretty sophisticated strategies on a short-term basis to either amplify your capital or get access to short exposure, which admittedly is tricky to get in many other ways as a retail investor. But to achieve long-term gains much more consistently, you really need a framework to build wealth over many years with a simple strategy, and that's exactly what I go through in this next video here.